It is 8 a.m. in Washington, D.C. The phone on your desk has not stopped ringing. Every major financial institution in the world is waiting to hear what you are going to do. You are Kevin Warsh. As of today, you are the 17th chair of the Federal Reserve, the most powerful financial position on the planet. And you just inherited a nightmare. Inflation running at 3.8%, a 3-year high. Wholesale prices up 6%. A war in the Middle East blocking the Strait of Hormuz and pushing oil and gas prices through the roof. A divided committee, and your predecessor, the man you just replaced, sitting right there in the same room, watching everything you do. The president wants lower interest rates. The economy says it cannot afford them. The market is watching every word you say. And your first meeting is in 32 days. This is not a political story. This is a money story. And the decisions made inside that building in the next 12 months will change what you pay for your mortgage, your car loan, your credit card, and your savings account. Stay until the end, because the trap Warsh just walked into has a direct path to your wallet, and most people have no idea how. Man who just took the most dangerous seat in finance. Kevin Warsh is 56 years old, Stanford undergrad, Harvard Law, Morgan Stanley Mergers and Acquisitions. In 2006, at just 35 years old, he became the youngest person ever appointed to the Federal Reserve Board of Governors. He sat in that room in 2008 when Lehman Brothers collapsed, when the entire American financial system was 48 hours from seizing up completely. He was there for the emergency decisions, the overnight phone calls, the moments where the wrong choice meant millions of Americans losing everything. He has seen this job at its worst, and he chose to come back. But the challenge he is walking into today is different from 2008 in one crucial way. In 2008, everyone agreed on the problem. Print money, stabilize the banks, stop the bleeding. The direction was clear. In 2026, nobody can agree on anything. The president says cut rates. The inflation data says don't dare. The hawks on the committee say the next move might be a hike. The markets say hold steady. And your predecessor, Jerome Powell, is still in the building. Elizabeth Warren called Warsh a sock puppet for Trump during his confirmation hearing. He was confirmed 54-45, the most divisive Fed confirmation in American history. One Democrat crossed the aisle. The other 44 said no. The impossible decision that affects every dollar you own. Here is the problem in plain English. The Federal Reserve controls one thing above all else: interest rates. When rates go up, borrowing gets more expensive. Mortgages get harder to afford. Credit cards cost more. Businesses slow down hiring. And eventually, inflation comes down. When rates go down, the economy gets a shot of adrenaline. Borrowing gets cheap. Businesses expand. Markets rally. But if inflation is already running hot, cutting rates throws gasoline on a fire. Right now, the fire is still burning. Consumer prices rose 3.8% in April alone. That is nearly double the Fed's target of 2%. Wholesale prices, the prices businesses pay before they pass them on to you, went up 6% in April, which means what you pay at the grocery store is about to get worse. And underneath all of it, a war. The Strait of Hormuz, the narrow waterway between Iran and Oman through which roughly 20% of the world's oil travels, has been effectively blocked for over 2 months. The result? Oil prices surging, gas prices surging, food prices surging, because everything that moves on fuel. So here is the trap Warsh just walked into. If he cuts rates to please the president, he pours fuel on an inflation fire that is already being fed by a war. If he hikes rates to fight inflation, he risks tipping a fragile economy into recession. And if he holds steady, he does nothing while everyone's money gets quietly eroded by the highest inflation in 3 years. Economists call this stagflation. Slow growth, high inflation, no good options. The last time the Fed faced this was the 1970s. It ended with the deepest recession since the Great Depression. The ghost in the room. Powell's revenge. Now add one more layer. Every Fed chair who has ever left that office has walked out the front door and never come back. Not Powell. Jerome Powell, the man whose chair you just took, is still sitting at that table. His term as chair is over. but his term as a governor of the Federal Reserve does not end until January 2028. He has a vote on every interest rate decision you make. This has not happened since 1948. Why is he staying? Because in 2025, the Trump administration launched a federal criminal investigation against him, grand jury subpoenas, related to a $2.5 billion renovation of the Fed's own headquarters building. A federal judge threw out the subpoenas in March 2026, calling them, in writing, an attempt to harass and pressure Powell to resign. The investigation was dropped in April, but Powell said he was staying anyway. "I had long planned to be retiring," he told reporters, "but then all of this happened." So as the new Fed chair, you are not just navigating inflation, a war, a divided committee, and presidential pressure. You are doing it with your predecessor sitting next to you, watching every vote, casting his own. No Fed chair in 78 years has faced this. The question is not whether Warsh is capable. The question is whether anyone is. What this means for your money. Right now, you are not Kevin Warsh. You are not in that room. But every decision made inside it lands directly in your bank account. Here is what the market is currently expecting. Rates stay where they are for the rest of 2026. No cuts, and a 30% chance, rising, of a rate hike by December. What does that mean for you? If you have a variable rate mortgage, your payment could go up. If you are carrying credit card debt, the interest rate on that balance is not coming down. If you were waiting for mortgage rates to fall to buy your first home, that window is not opening this year. But here is the other side. If you have money in a high-yield savings account, a money market fund, or short-term treasury bills, you are being paid to wait. High rates are good for savers, bad for borrowers. And what about the stock market? A rate hike would likely trigger a sell-off. Holding rates steady in a high-inflation environment makes stocks a worse deal compared to the return you can get just from cash. And cutting rates, which the market would love, is the option the economy can least afford right now. Here is the one actionable insight from everything happening in that building right now. Pay down variable rate debt. High-yield savings accounts are your friend. And do not bet on rate cuts in 2026. The trap Warsh is in makes that the least likely outcome. The question. Everyone is afraid to ask. Here is the question. Nobody in a suit on financial television is asking out loud. Will Kevin Warsh do what the president wants? Trump nominated Warsh specifically because he believed Warsh would cut interest rates. Trump said in December 2025, publicly, that he wanted a Fed chair who would cut rates when the stock market goes up. He added, "Anyone who disagrees with me will never be the Fed chairman." Warsh told the Senate he had received no instructions, that he would make independent decisions, that no rate had been predetermined. But Elizabeth Warren called him a sock puppet for Trump, and 44 senators voted against him. Here is what history says. The Federal Reserve has operated as an independent institution for over 100 years. Its independence is the reason the US dollar is the world's reserve currency. It is the reason international investors still trust American financial institutions. The moment markets believe the Fed is taking orders from the White House, that trust erodes. And when trust in a currency erodes, the currency weakens. And when the dollar weakens, everything you import gets more expensive. Every item on every shelf, every tank of gas, every piece of electronics. What happens inside that building in the next 12 months will either protect the independence that has kept the US dollar trusted for a century, or it will be the moment we look back on as the beginning of something we did not see coming. Kevin Warsh officially became Fed chair at midnight. His first meeting as chair is June 16th. Here is what to watch between now and then. Watch how Warsh talks. Powell was known for press conferences. Warsh wants fewer of them. Less communication from the Fed means more uncertainty in the markets. More uncertainty means more volatility. More volatility means your investments move more. Watch how Powell votes. If he consistently votes against Warsh's position, that is a signal that the committee is more divided than the official statements suggest. And watch the inflation numbers. If they keep rising, the 30% probability of a rate hike by December goes up, and your borrowing costs go with it. The most powerful financial seat in the world changed hands today. Most people do not know what that means for their money. Now you do. If this changed how you see what is happening right now, share it with someone who needs to understand it. Subscribe to Capital Explained. Every week, we go inside the financial stories the world hopes you never fully understand. This is Capital Explained.